Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. It's August 2025. This video is number 8 of the series we call Alternatives Investment Reality Check. In most of this series, our focus has been on the disappointing returns of alternative investments on average when analyzed appropriately. In this video, we shift attention to the risk illusion, the comfortable yet false notion that alternative investments have relatively low risk and a low correlation to liquid investment markets. It's very easy to find statements from experts which support the risk illusion. All of these shown here are from recognized investment authorities, and they all suggest that a portfolio shift from liquid assets to alternative assets will reduce portfolio risk, perhaps significantly. These statements are valid in a very narrow sense. Because alts managers have flexibility in choosing what market values to report, and because they report those values infrequently, there is an illusion that the volatility and correlation of alts are low. The danger is that an unsophisticated investor could believe that the illusion is real, that alts really are a low-risk diversifying choice and add alternative investments to their portfolio without really understanding the risk that they are taking. A stark illustration of the risk illusion is provided each quarter by JP Morgan. This chart is from their Q2 2025 Guide to Alternatives. The left chart shows the correlation of REITs, publicly traded real estate investment trusts, to the S&P 500 index. The correlation of REITs to stocks has been high. The right chart shows the correlation of the real estate private fund index to the S&P 500, and that has been low. The inference is that private real estate is a much more diversifying choice than REITs would be for an investor who also owns stocks. If you think about it carefully, the inference that JP Morgan is promoting is not logical. Imagine two quite similar office buildings in your city. The one on the left is owned by a private real estate fund, and the one on the right is owned by a REIT. Now there's news of weaker economic growth, which leads to a stock market sell-off. According to JP Morgan, that bad news would also negatively affect the value of the building on the right because it's owned by a REIT. Luckily, the value of the building on the left is immune from the bad economic news because it's owned by a private fund. But if you believe things like that, then the alternatives industry would be happy to have your money. So an interesting article about the risk illusion in private equity just came out from Verdad Capital. The London Stock Exchange permits listings of private equity funds which are actively traded, and that allows for a fair comparison of the actual level and risk of the market value of the private equity funds, to compare that to the risk and values as they're reported by the fund managers. Based on the net asset values as reported, the price risk of this group of funds has been just 8%, only half of the risk of the S&P 500. But as traded on the London Stock Exchange, the risk of these same funds was 24%. And that's 50% more than the risk of the S&P 500. This is a dramatic and valid counterpoint to the risk illusion in private equity. Suppose we compare the net asset values reported by these London-listed private equity fund managers to the listed market prices for the same funds. We can make an interesting observation. When market prices are rising, the fund managers respect the collective wisdom of the market and show 100% of the gain in market prices in their reported valuations. But when market prices are falling, as in the circled areas on the chart, the market is no longer considered to be wise. The value reductions reported by fund managers are only a tiny fraction of the reduction in the market price. This limited recognition of losses by private fund managers is a key reason why alternatives appear to be less risky than they really are. On our first slide, there's a statement from KKR which asserts that direct lending has only 1/4 of the volatility of the stock market. Let's test that proposition by looking at business development companies, or BDCs, direct lending companies which are listed on the stock exchange. This chart shows the history of one-year price changes for BDCs and the stock market. We can see that the two markets have a very high correlation. Moreover, far from having just a quarter of the risk of the S&P 500, the actual risk of BDCs has been larger than the risk of the S&P 500. Investment professionals know that the reported alternative market values disguise the actual risk and correlation of the investments. No sophisticated investor is really fooled by the alternatives' risk illusion. Rather, it's a very useful fiction. Nearly everyone who would go to an investment conference, the alts managers, the consultants, the wealth managers, the investment professionals, they all believe their future will be better if the alternatives boom continues. No one really has an incentive to express doubt about the stories which help keep the boom rolling along. So, to sum up, when making investment choices, it helps to use valid assumptions. The risk illusion has been helpful to the growth of the alternative industry, but actual risks and correlations should be used when making investment decisions. As I show here, when we can make valid comparisons of the risk and correlation of alternatives to liquid markets, what we typically find is 1. Alternatives are at least as risky as the equivalent liquid investments, and 2. Alternative investments are highly correlated to the liquid investments they replace. If you are considering adding alternative investments to your portfolio, I hope this information about the risk illusion will be helpful. Thank you for listening.